So good afternoon, everyone, and warm welcome to the post-budget webinar hosted by the Indian-American Chamber of Commerce. Thank you all for joining us today as we come together to discuss the key themes and implications of the Union Budget 2026, especially in the context of India's long-term vision of achieving the Viksit Bharat 2047 and strengthening its position as one of the world's leading economies. This year's budget is inspired by three kartavyas. First, clear focus on economic growth with resilience. Second, empowerment of citizens to achieve their aspirations. And third, inclusive development under the guiding principle of Sabka Saath and Sabka Vikas. On the tax front, we see an important shift from the punitive approach to a more compliance-driven and facilitated regime, with measures aimed at the decriminalization of minor offences, dispute reduction, and greater certainty for taxpayers. The budget also addresses long-standing industry expectations, whether through simplification of tax and custom procedures, support for technology and infrastructure, or initiatives to enhance India's global competitiveness, particularly in cross-border trade and investment. Against this backdrop, today's discussion is very timely. We are privileged to have with us an eminent panel of policymakers, industry leaders, and tax experts who will help decode the budget announcements, assess their practical impact, and share insights of what lies ahead for businesses and the economy. Once again, warm welcome to all our speakers and participants. Let me begin today's session with opening remarks from our regional president of IACC, Mr. Manoj Kesai. Before I ask Mr. Manoj, I'll give a brief introduction about him. He's a counsel at SNA Law Offices LLP. He's a leading litigation and arbitration expert specialized in infrastructure-related disputes and also served as a special counsel to government bodies. Mr. Singh has been recently recognized as India's top 30 litigators by ALB Thomson Reuters and recognized by the ET Legal 500 for excellence in arbitration. Mr. Manoj, request you to share your initial thoughts on the budget and the overall direction the Indian economy is expecting to take over the next 5 to 10 years.
Oh, thank you. Thank you very much.
Yes, sir.
Yeah, thank you, Akhil. And good afternoon to everyone. And thank you for joining us today. To me, the Union Budget 2026-2027 is less about grand announcements and more about how the economy will actually function over the next few years. The Finance Minister, through the proposals made while presenting the Union Budget 2026, has laid down the roadmap towards next phase of India's growth trajectory and keeping the momentum regards target of becoming a strong manufacturing hub. This is very important to me. The focus on making the supply chain resilient by various measures such as expanding PLI-linked sectors and export competitiveness clearly shows the government's determination towards not just Atmanirbhar Bharat, but also position itself as a trusted global manufacturing hub. And this is again going to be very important in the coming years. Emphasis has been laid on investments and making compliance in this regard smooth. Foreign companies have been given exemption from tax on income from specified Indian data center services up to 31st March 2047. High-level committee to be set up for simplifying non-debt instruments framework with a focus on facilitating ease of doing business. So the government core message to stakeholder, in my view, is quite clear. Capital will be deployed, reforms will be executed, and performance will matter. For businesses, one of the most intermediate takeaways is continuity in public investment. Infrastructure spending remains strong, which means sustained demand across sectors, constructions, logistics, manufacturing, services, and financing. At the same time, sharper focus on MSME, faster payments, and easier access to credit indicate a genuine attempt to improve cash flows and reduce operational bottlenecks. There are some very important steps taken in this regard, such as PRIO or to encourage issuance of municipal bonds, that is debt securities issued by state, local government or their agencies to raise funds for public infrastructure projects like school, highways, water system, and hospitals, etc. An incentive of INR 100 crore has been announced for single bond issuance of more than INR 1,000 crore. Working towards the motto of Kartavya and Viksit Bharat, integrated program for textile sector, biopharma, semiconductors, electronics, chemicals, capital goods, and sports goods shall be promoted. Biopharma Shakti and Semiconductor Mission 2.0 to be initiated. Apart from setting institutes and labs in school and colleges for animation, visual effects, gaming, and comics. Creation of champion SMEs through initiatives like SME Growth Fund, Self-Reliant Fund, and Liquidity Support. A step toward 3 core of Kartavya: growth, capacity building, and inclusion. Establishment of infrastructure risk guarantee fund to strengthen confidence of private developers as they face various challenges, and participation of private sector is of importance for any country. Infrastructure is further being boosted with proposal of 20 new national waterways, 5 university townships in the industrial and logistic corridors, dedicated rare earth corridors in the states of Odisha, Kerala, Andhra Pradesh, and Tamil Nadu to feed the industries through domestic sources instead of relying on other countries. 5 regional medical hubs to promote medical tourism. Another practical shift in the area of taxation compliance, simplified processes, lower litigation, and rule-based system signal a move towards predictability. This reduces time spent on compliance and allows entrepreneurs and professionals to focus more on growth and execution. The budget brings in a comprehensive fine-tuning the India's indirect tax framework with announcement of wide-ranging customs and excise measures intended at streamlining tariffs, consolidation of domestic manufacturing, enhancing export competitiveness. The proposals are aimed at giving a push towards government's intention to align trade policy with the government's larger goal towards Viksit Bharat. The proposal of custom rate rationalization in strategic sectors like renewable energy, aviation, pharma, nuclear energy, electronics, critical minerals would work towards strengthening manufacturing and export. The government aim towards reducing procedural complexity is also evident from the proposed changes in both custom and GST amendments in refund procedure, catering to inverted duty structure, issuance of credit notes in post-sale discounts, etc. These changes will definitely have a positive impact on the cash flow and easing working capital constraints for affected taxpayers. The government's emphasis on the digital economy and innovation is equally noteworthy. Continued support for digital public infrastructure, fintech, artificial intelligence, and emerging technologies reinforces India's leadership in innovation. There is immense scope for deeper India-US collaboration in startups, research and development, next-generation technologies, areas where both nations naturally complement each other. The budget also places clear emphasis on employability and skills aligned with industry needs, whether in manufacturing, healthcare, tourism, digital services, or creative sectors. This is not just about social outcomes. It directly affects productivity and talent availability for enterprises. The Union Budget 2026 unlocks new avenues across key sectors, including healthcare and life sciences, agro and food processing, BFSI and fintech, renewable energy and climate technologies, travel and tourism. Today, interactive session will help us understand how these policy measures translate into actionable business opportunities. So now, for all of us, the real question now is not whether the policy direction is right, but how effectively it is implemented and leveraged. Today's webinar is therefore timely. It allows us to understand what the budget means in practice, identify opportunities, and flag challenges from the ground. I look forward to an insightful and forward-looking discussion. Thank you, and I wish the session a very productive start. Thank you very much, Akhil. Over to you.
Thank you, Manoj sir. I'm audible, right?
Yeah, you are.
Yeah, audible. Okay. I think there's some problem with my camera, but I'll continue. Thanks for summarizing the entire 85-minute speech by our Honorable Finance Minister in 10 minutes for the benefit of the people. What I like about, there are many key takeaways which talked about, but message is very clear that capital will be deployed, reforms will be clear, and performance will be evaluated. So with this, I think you've given the direction the Indian economy is expected to take over the next 5 to 10 years. Now, next, let me move to an important dimension of today's event, the integration of Indian and US economies, and the measure proposed in this budget to strengthen our ties with the US. I think the development which has happened last night, everyone is aware about this. May I call upon Lloyd Pinter, who's a senior partner leading US tax advisory in Grant Thornton Bharat LLP. He advises multinational clients on US tax structuring, compliances, cross-border tax management. His experience spans with diverse industries helping organizations navigate complex US regulations while optimizing global tax outcomes. Lloyd is a perfect candidate to provide us an insight on how the budget has economic relationships, now especially in the context of recently announced trade rate deal that reduces export tariffs to 18%. Requesting Lloyd to share his valuable insights on Indian US economy perspective before we go to our chief guest of honors, as Mr. Asim Chawla will be joining us in any time sooner. But Lloyd, your inputs would be highly important for us.
Thanks, Akhil, for that. I think, of course, yesterday's announcement, is front page news for everyone. But I think even before we get to that, the budget definitely, was preparing sectors and economies in line with the talks that have been ongoing for a while, right? There were certain sectors, certain demands that were being made during the trade negotiations. The budget did try to balance, and provide for some of those expectations. There were certain other sectors which were severely impacted by, the tariffs before they were reduced yesterday. So there was budgetary support provided for some of those sectors. I'll just give a few inputs on, what we saw coming in from the finance minister. I think one of the key announcements that has been talk of the town has been the tax holiday that was provided for data centers up to 2047. That definitely is, one of a key asks of, on the ongoing trade talks where they wanted access. U.S. multinationals wanted access to, the Indian space so that they can set up data centers in India to allow access to some of the resources that are needed for the very infrastructure heavy requirements for especially the AI companies. Affordable access to land, energy, water. The Indian government responded by allowing, income tax breaks to data center companies. Of course, there are riders that, these companies should provide services also to, Indian consumers through an Indian reseller. So we've kept some of our interests aligned there as well. But I think this was one of the significant developments from a budget perspective. A couple of other areas where it has benefited, companies in the Indo-US corridor. There have been concessions provided in the nuclear space, certain customs duty exemptions provided for import of certain nuclear equipment. US is one of the largest exporters of nuclear equipment, so that is definitely going to benefit companies in this space. Several changes were also made in the aviation sector. Again, duty exemptions provided to certain, airline components, certain MRO providers. So again, there have been concessions which would also benefit a lot of companies in the US in the aviation sector. The budget also tried to provide some support to industries which were impacted by the heavy tariffs. All were aware about the textile sector, which was significantly, impacted by the high tariffs. I mean, before yesterday's announcement, but the budget definitely tried to provide some support, through capital support for the machineries and also providing opportunities to modernize the textile clusters. Some incentives and some benefits were also announced for the seafood exporters and the leather exporters, allowing them some duty-free imports on some of the inputs that were needed. So overall, the budget did try to balance, some of the negotiations, allowing certain concessions to industries that would benefit in the IT space, data space, and some of the aviation and nuclear sectors. On the tax reform side, another important element, not just for the US, but generally for multinationals at large, was the safe harbor provided to the services industry, which would benefit a lot of IT-enabled companies, including the GCCs. I think that's been another important development of our budget, the 15.5% safe harbor that is provided to all IT services. That will go a long way in reducing, tax litigation and providing that tax certainty and ease of doing business to multinational corporations. That has been the ask from the industry for such a long while. So overall, I think the budget made a lot of announcements that enabled cross-border commerce. Of course, yesterday's developments with the additional reduction in the tariffs to 18% and removal of the penal 25%, additional levies, I think has now made Indian industry extremely competitive, especially in the Asian corridor. I believe that makes India pretty highly competitive amongst some of their neighboring countries like, Sri Lanka, Bangladesh, Thailand, etc. We are slightly better placed at 18%. Some of these countries are at 19, 20% and above. So on the whole, I think positive developments over the last few days, some announcements from the finance minister, and of course, the relief coming in yesterday from President Trump. Overall, this augurs well for companies in the India-US corridor. Back to you, Akhil.
Thanks, Lloyd. Thanks for such a detailed insights and very valuable on India-US economic perspective. Obviously, the last night development was very timely. But let me ask you two questions. The first is, what according to you will be the impact of the government's move to give tax holiday to foreign companies who take up data center space in India? Specifically, we want to understand how this move will help the US-based global cloud hubs. And in your view, does it make India an attractive options for global cloud hubs?
Yeah. Thanks, Akhil. So I think, see, all of us are aware that, with the fast-moving developments happening in the AI space, a lot of these companies are dependent on power-hungry data centers. And in that space, I think, as Mr. Manoj also alluded to, we are setting ourselves up as a country to become the hub, for these data centers. Of course, there are other countries in this race, but I think the push from the central government and the support from the finance minister will definitely attract a lot of capital, in this industry. Of course, we have the resources available, land, energy, water, and there are several locations in India where these could be set up. It will drive employment, it will drive consumption in these areas. The cascading impact of these developments for the surrounding economy in these cities, wherever these data centers get set up, will definitely be very useful. And of course, for the multinational companies looking to set it up, two important things. One is access to resources, and secondly, tax certainty, with the tax holiday being there until 2047. That will definitely attract a lot of capital towards this industry. So I think all of this augurs well. India trying to simplify its overall tax reforms, not trying to spring surprises, will attract capital, and of course, making it even more fiscally attractive by providing tax incentives. I think both these put together, this is a space that I think we need to watch for the next few years. And we are definitely making it attractive for multinational corporations to come here and set up their data centers. So a very attractive space, and we look forward to seeing a lot of investment in this area.
Thanks. I think what I can conclude as per your inputs is that it's very encouraging and give a lot of impetus for a lot of AI space to come and start building up their data centers in India, which anyways will contribute to the overall development of AI ecosystem for our country as well. Now, my second question, quickly, the current budget has proposed to exempt foreign companies from taxes on machinery provided to contract manufacturers for 5 years. What do you think will be the impact of this proposal specifically for US electronic companies?
Again, I think this is a very forward-looking announcement. Mr. Manoj mentioned that we are looking at setting India up as a manufacturing hub, right? And if we need to develop those manufacturing capabilities, access to capital equipment, tooling, etc., will be very, very critical for these companies, from the electronics manufacturers and other manufacturers which are being incentivized through the PLI and other incentives that we are allowing such manufacturers. I think the China Plus One strategy, a lot of companies have been talking about. There is definitely a dire need globally to have a strong alternative to some of our neighboring countries from a manufacturing space. The world has seen what we have done in the services space. I think the next few decades, if we are able to establish ourselves as a manufacturing powerhouse as well, we are definitely on that journey towards the Viksit Bharat that we're all looking forward to. I think that's the positioning, that's the incentive that we are being provided to make manufacturing more competitive. So that's the benefit or the fiscal incentive that the finance minister has provided, and definitely a lot of companies in this space, we expect them to benefit from this incentive. So again, it's looking forward towards developing India as a manufacturing center as well.
Thank you, Lloyd. I think very insightful inputs again. Now with the perspective and the inputs you've given, let me move to our next panelist to enlighten us about the theme of the government in this year's budget. Let me introduce Mr. Aseem Chawla, who's a senior advocate and a member of Bar Council of India and fellow chartered accountant with over 2 decades of experience in tax, estate planning, and governance. He has led leadership roles in several national and he's a mentor for me in Indian-American Chamber of Commerce as well. Thank you, sir, for joining us today. We extend our warm welcome for today's session. And there's some technical glitch in my system, so I'll have to restart the system. But I'm handing over to you to extend our warm welcome to our chief of guest as well, and then address the participants on what you think are the major headliners of this year's budget.
Thank you, Akhil. I think
Yeah.
first of all, my congratulations to our leadership, Mr. Manoj Singh. I think he timed it so well, knowing that the tariffs announcement would happen overnight, and that's the reason we are having budget. So he brings a lot of statesmanship. I mean, I will be very limited. My apologies. I am still intruded by my day job in the court, and I'm so honored that Pitambar Das Saab as well as Mr. Chetan Roy did accede to our request. And I think I would rather be in the benefit for all our audience, both India and internationally, would keep it very brief. And we have other experts, both from AKM as well as from GT, who have to address it. So very quickly, I think for somebody who's still a student of law, I found the finance bill and the explanatory memorandum a very unique reading after a very long time, that you are parallelly navigating two acts, the 61 Act and the 25 Act, which was very refreshing, very unique for some of us. I think the space available to suggest the fact that we have a new act coming in less than 60 days would have kept the TPL very conscious, and the fact that there's an overnight working on the framing of rules and the forms, etc. On the on the space itself, with regard to some expectation on sweetener coming on a little bit more following the last year's budget, I think the tax buoyancy and the nominal GDP and the tax to GDP ratio, I think those would have been the broader indicators. I understand the share of direct taxes over the years have increased vis-a-vis indirect taxes, but then I think the nominal GDP and the fact that we have still a long way to go in terms of effectiveness, in terms of number of taxpayers and the absolute tax collection, considering the population, tax filers and taxpayers. I think the budget does present, I think, a roadmap which is a sequitur to what was presented a couple of years ago on 75 years of our independence, and now taking it to the next level in terms of trying to unleash our full potential. I think GIFT is very promising. We've already had about $26.3 billion of commitments within the GIFT city. So therefore, a lot of developments which are positive in terms of more than announcements, and I hope we'll get to hear more in terms of the actual implementation of them in the coming period of time. I think India presents itself as a very compelling jurisdiction in terms of the entire package, a whole host of it, whether it's the new economy, AI, semiconductor and the glitches around what you heard from Lloyd in terms of the ITS, Safe Harbor, making Safe Harbor more sellable, bringing India to that stage where we can't afford to let ourselves down. I think I'll restrain myself here. I'm very rather keen to hear from not only our two luminaries present, but from the other experts. So, Akhil, over to you. Bye. Akhil, are you there?
Sir, can I request you to introduce Mr. Pitambar, sir, because
Well,
he has to leave?
okay. So it's a great pleasure and honor to have somebody whom we've all looked up to all this while. Mr. Das brings a great amount of erudition and his breadth of knowledge. And within the TPL, I can certainly speak in my prior role when I was assisting the revenue, how much value is brought to the table along with Mr. Rao. So, Mr. Das, extremely grateful to have you. And your predecessors have blessed us all along, right from Varshney Saab, Raman ji, and I'm glad that Chetan has also made it. Over to you without much ado. Most grateful for your time.
Thank you, IACC, for giving this opportunity. You want to say something? Shall I start?
Yeah,
Because
sir. Yes, I'm back, and I think Mr. Chawla must have introduced you, but
yeah.
we are very thankful, because the perspective you bring, our panel would have been incomplete without your invaluable insights. So we are looking forward to hear from you, and we have some questions for you, which I will ask you once you give us a perspective overall on the budget.
Yeah. So this is a budget which was extremely awaited from business perspective, and we are at the crossroad of making things very clear about our policy. So therefore, the challenge was very, very high. And I'll just tell the whole of budget proposals, we can see that it is revolving around one issue of attracting businesses and investments. So that equally applies to US or anywhere in the world. All these are facets. Then we found out why we emphasize on various proposals. Proposals can be broadly categorized into a policy, clear policy to prevent litigation. I'll explain why this is very important. Second is there are some tax certainty has to be provided for manufacturing and some services. That also is very priority. Then, of course, we have to start with a trust-based tax administration. So these are the three core limbs, and the residual is some course corrections are also necessary through policy that we did. So why this preventing litigation as a core policy? That actually revolves around one aspect, that the fighting to bring or the competition to bring businesses and the investments through reduction in tax base or tax rate is now over, almost over. Now you can see that every country is now at the same power to reduce the tax rate. You can see that most of the G20s are revolving around same kind of corporate tax rate. Tax base are no longer to be reduced because globally we have agreed for global minimum tax also. So therefore, the only way that a cost can be reduced is actually minimizing the litigation cost. So therefore, the focus of this budget proposal is to make a long-term policy to give or prevent litigation so that the businesses can do or compete while doing business in India from a cost perspective, which is substantially higher so far as litigation is concerned. So therefore, the focus of this whole exercise was to revolve around this. Then some sectors that we still want manufacturing or services to grow because India has that kind of edge. So we want to give certain kind of tax certainty. And third is, again, a fallout of all these things, that we have to then develop a system where actually we trust taxpayers. The administration has to trust taxpayers more. More, so that, most of the litigations can be avoided by that trust itself. So what is this? I'll just tell how to prevent what we thought about. When a taxpayer actually interacts with a income tax department, it starts with filing of return. Basically, the whole process, if I'll glide you through from filing of a tax return till tax assessment, how it actually, the prevention of litigation has been the core policy, and that we have actually initially we have, that in the filing we have 3 dates. So one is 31st July, then is October for companies, then for TP assessment it is 30th. We thought that 31st July is actually difficult for businesses which are non-audited. So we created a window separately on 31st of August to give them a time so that they make a correct return. Instead of 31st July, we gave another 1 month time to file the return for non-audit business cases. That is first. Second, there has been a lot of issues to revise the return. It is not essential that everything comes out at the first go. So initially it was 31st December. So it was very less for companies which are filing a return, say TP return cases. It is filing on 30th of November. So they don't have even a month's time to correct. So we increase that time window to March with a nominal fee to be charged for that. So therefore, the second that you can now, the return can be revised till a later period, another extension we are giving. Third thing is that that the taxpayers can now file a updated return up to 4 years from the date in which the original return is filed. So that 4 years, that updated return was the scope was a bit restricted in the initial stages, in the sense that when an assessment has started or reassessment proceeding has been started, you will not be able to update your return. So that has been taken care of in this proposal, saying that even where a reassessment proceeding has been initiated, then also you can file a revised return. Of course, the rates are more than, slightly more than what the original updated return could have been filed. That is a different issue. The issue is that. Now, fourth, when assessment takes place, the most significant aspect of that assessment goes for few years to get finalized, say 4-5 years. Then a penalty proceeding also simultaneously started, who goes or spill over to another 3-4 years. So one assessment year suffers around 7 to 8 years of assessment or penalty proceeding. So what we did, we brought out this proceeding by combining the order of assessment and penalty at one go. So that means the taxpayer can know about his liability of the entire proceeding at one go. Substantially, the time of litigation was expected to be reduced, maybe at the same time at the assessment is passed. Now, question would be how to collect. So that mechanism already, FM madam has already made in the speech, saying that no interest would be charged on the penalty till the first appeal is disposed of. The tax to be paid for stay is 10% instead of 20%. That is on the court tax demand. So that we have already addressed that issue. So the point that is made here, that all taxpayers now, instead of lingering that process for 8 years, which is a very high litigation cost, now can reduce their litigation time period to very minimal stage. So that is the fourth is that once the assessment is made, there is a penalty of underreporting or misreporting. Initially, we have a window to settle this on underreporting cases by granting an immunity, that you can get a immunity by paying the tax and interest due, and no penalty and prosecution would be initiated. That window has been now extended even to a misreporting case. That means where you are liable for a 200% penalty, you can settle or get a immunity from penalty and prosecution by making a payment of tax, interest, and 100% of the penalty instead of 200% and settle this. So why I'm saying this thing is that in the whole process, it has been granted enough space for the taxpayer to actually reduce his litigation on its own without even interacting with the department. So that, tax ecosystem has been provided so that assessee gets confident of, while doing a business or bringing in an investment in India. So that is one. Now, already we have heard that some tax certainty. This is one part which is relevant to the businesses. Other things are, I am not, because of time constraint, I am not going into that. Second is tax certainty. India still is a competitive jurisdiction so far as manufacturing is concerned. So therefore, particularly in the sector of electronic manufacturing, we have given a complete tax ecosystem of the tax certainty for the non-resident or the foreign companies having a manufacturing activity in India. For example, a electronic manufacturer may have global vendors. They will supply some goods and they want a just-in-time manufacturing. Therefore, the goods has to be at proximity to the manufacturer. So for that, actually, they need a warehouse where the component vendors will store their goods to be used by the toll manufacturing or contract manufacturing. So that component warehousing will not be creating a business connection or a taxable presence in India. That certainty we have given. And only that when the sale value takes place, then there will be presumptive taxation of 2% on the invoice value. They have to pay a tax. So the certainty has been given for component vendors to store and sell their goods to the contract manufacturer. Second limb is that if the foreign player wants to have his capital equipment stored here, which will be used by the toll or the contract manufacturing for manufacturing of goods, then there is a tax certainty is necessary because this is a second limb of manufacturing process. So we have given that you can store in a custom bonded zone your capital equipment as well as tooling to be used by the toll manufacturer, and there will be no tax incidents. Presently, we are given up to 5 years. We'll see how things are going ahead. So we have given a tax certainty that at least to this extent you are not. So this is a complete ecosystem of tax certainty for those who want to manufacture in particular segment of goods. The second tax certainty that was necessary, which will be very important for US and other jurisdiction, is that services. Basically, India is a pioneer in providing information services, technology services. But the issue was TP assessment takes a lot of time, confusion, and then there are a lot of litigation on that front. Second is the timing, when to complete this process. That was also a debate. Then scope was very limited, that initial safe harbor rules, we do not have bigger companies to participate. So scaling was actually not useful to fall into this kind of activity. So 300 crores of turnover was initially introduced. So we thought that we have to give a complete solution for this thing. So what is this complete solution for information technology services? Is that we have provided now a safe harbor rule, including all segments of 6 segments of IT. That is IT, ITS, KPO, BPO, contract R&D for contract software development, and contract R&D for relating to software. All are grouped together as information technology services. One thing that will happen, that the categorization related dispute will be completely taken care of. That there should not be anything to say that you actually fall into this category, you are not falling into this category. So that uniformity has been brought in by bringing all 6 together under one roof, saying that information technology services. Then second is that now 2000 up to 2000 crore turnover companies can be eligible for applying for a safe harbor. So that is substantial. I'll tell from in terms of percentage, it is actually covering around 98.6% of our IT/ITS service in India. So except I can tell 100 big companies, all are now covered under the safe harbor, can be covered under the safe harbor. They can come under the safe harbor, except 100. So then there was a system that, that in India, 80% of APAs that we make is actually, it is unilateral APAs. So therefore, we have brought in for the first time that a timeline, a time-bound UPA. Unilateral APA has to be completed within 2 years time frame. That we have started as an advisory timeline, but that is statutorily it is provided for the first time. And fourth element of this thing is that the tax base also has been rationalized on all six to be 15.5% on the cost basis. So therefore, this is a complete solution of 98% of the companies to fall under one kind of. Those who are now left out is 100. Out of 100, I can say 60 odd companies have already filed a APA for 5 years and previous 3 years, 5 years and 4 years. So basically left out is 30. So 30 cases, we want to make a fast track APA program. Already renewal cases has to be fast track. So if you see, the entire IT system has been given a complete solution as far as tax certainty is concerned. So yes.
Yeah. So I'm sorry to stop you, but I think very well articulated, and I have a very topical question on this matter. Bundling of IT services under safe harbor. You said 15.5% margin and the ability to lock in the position for 5 years, give a lot of certainty on the services they are giving is a very welcome, and the industry at large has given a lot big thumbs up to this. But my question, two questions around that. How should companies manage the transition for pending assessments and litigation where materially higher margins are being proposed? That's my first. And the second is already concluded APAs that lock in higher margins for upcoming years. So what are your thoughts on the transition strategy for these kind of companies?
The law is to be applied prospectively. So there is absolutely no, confusion on that. It has to be from perspective. So therefore, this program will come after 1/4/2026. Whatever happened earlier, it will be because they have taken that, position by factoring out a lot of issues, including the risk involved in the doing business. So therefore, disturbing that, actually, it is going to be the wastage of your, the public resources already spent on that. So therefore, by looking forward, whatever new things will come up after 1/4/2026 will be applicable to those kind of new regime. So there should not be any confusion on that. Now, those cases already assessment is pending, where the notice has already been issued. Probably, also it is, they can also apply for this thing. I don't think there is any confusion. Those where things are already completed, assessment is completed, or your APA has already been signed, probably they are kept out of. There is a conscious decision to keep this out. Otherwise, things will not be. And you know that in tax matter,
Yeah.
things change every year, but that doesn't mean that it has to be, applied prospectively, because there is no stopel in tax. So basically, we give benefits and we withdraw benefits, but it is always perspective. So that is the standard legal position that we need not have to be bothered about that. But this is how we are going forward. We are giving this tax certainty so that the larger segment of our services is now around 65% Indian GDP. So, and this IT related services, if you say, it is significant. So therefore, we are hoping that this policy will now settle a lot of, tax issue and litigation issue so far as this sector is concerned. So this is, I think, one more. I think I have to tell, because there is a provision for expats. We always talk about creating an innovation. India should be actually leading towards a innovation hub. So we give a lot of benefit to the businesses, either through deductions of capital expenditure for R&D, or at the end when a product is find out a patent is made, then we give a concessional tax regime for income of patent. That we have given. But we have forgotten one segment of it, that the innovations are always brought in by individuals. So what is there for the individuals to actually come and do innovation? Innovation, actually, businesses doesn't do innovation. It is done by persons. So basically, that experts, one proposal we have brought in, that we must open up the doors with a tax certainty for the foreign experts, whether it is a professional or it's it's academician, or it is an researcher, they can come and stay for a longer period of time in India, so that their tax certainty is given in advance. Why this was important? As per our tax policy, the residents are taxed on a global basis, whereas the non-residents are taxed in a very limited way for the income sourced in India. So when a non-resident travels to India and stays beyond 182 days, generally he becomes a resident. The question would arise then, India should apply the global source rule to tax their income. So there was a hindrance. So basically what we have given in this proposal, that any non-resident who comes under a government notified scheme to do research or any teaching or any kind of similar activities or technological activities in India for 5 years, their income would not be taxed on global basis. They will only be taxed as on their India social income. So that certainty has actually given in a way forward to promote the innovation. That is one way we thought that it would be extremely important. So I think other things are, and then some course corrections we have.
So before we move, I have another question on this expats thing. I think a very, very big and very, I would say aggressive move, because firstly, we have to India or the foreign nationals or Indian citizens who have been staying outside India, but after many years they've come back. So in the fourth year they become ROR, resident and ordinary resident, and their global incomes gets taxable. So, sir, as I understand, all the amendments are prospective. But for the expats who are already in India, they are in the first year of their assignment or second year of an assignment. Will they be able to take the benefit of the scheme, which you're proposing? No.
Actually, proposal is very clear that there should be some government notified scheme which is
Yeah.
going to come. Under that scheme, they have to come,
And
and then
even
they will enjoy. Yeah.
okay, understood. Okay, got it. So that and if we can throw some light on the scheme, you talked about researchers, professionals.
Yeah. Actually, if you know that lot of premier institutions in India like IITs, they are tying up with various foreign universities. Professors are willing to come and teach here for a longer duration.
Got it.
Researchers can come and stay here and do research on various, critical and strategic industries. And then some technology people who want to come and, develop their technology and, for the use of industries, they want to stay for a longer period of time. So the government will now start notifying, the line ministries will do it, and accordingly those experts will come under that, they will be benefiting from this scheme. Yeah.
Understood. I think very, very good move, sir.
And now,
Sir, yeah. So one very important question, which I know you have a hard close at 4, but I wanted to optimize and capitalize that time. As you know, that recently there's a Supreme Court ruling in case of Tiger Global, where the taxpayers, especially the tax deductors, were expecting certain safeguards to be specified as a part of they were expecting that some kind of budget announcements will come in line of whatever Supreme Court pronouncements done. The tax deductors while making remittance to the non-resident located in tax havens, but the budget seems to be silent on these aspects. So, any thoughts?
Yeah, I'll just take you to some of the existing provisions that will make things clear. When a remittance is made, the tax is to be deducted under 195. The old act. I am not going to the new act. So what happens that time? Actually, you have to apply the deductor has to apply a rate. If the deductor is not, sure about what should be the taxable, TDS or the TDS rate, then probably he has to ask the deductee, and deductee in turn has to apply under 197 to get a tax certainty, like a lower deduction or the deduction rate. They get it, and that is communicated to the deductor. Deductor can deduct while making a remittance. Or under 195, deductor also can approach the office, department to say that what could be the ideal rate. Now coming to your question is very pointed and targeted, that when there is a tax haven, deductee is in the tax haven, now how the TDS would apply. Look, generally the TDS has to be applied as per the domestic law, because that is the domestic law applies to all kind of. Then where there is a treaty, then treaty restricts the application of domestic law. when you say that it is a tax haven, obviously we do not have a treaty or a limited treaty. So in that case, of course, the tax rate as per the domestic law will kick in, basically, because only when there is a treaty which is applicable after certain line, that TRC thing, if it is applicable, then treaty rate will come into force. That restricts the operation of domestic rate. But when there is no treaty, then probably a deductor has, more clarity on what should be the rate. Rate has to be the domestic rate. Then he has to apply the domestic rate. Now, coming to the Tiger Global, I'll just focus on some policy issue that should be actually highlighted instead of going into the nitty-gritty of the interpretation of how the avoidance scenario, what could be the taxability of an entity that provides. One has to actually understand the tax policy perspective. Domestic law, we have wide power to tax. Okay, so anything can be done. That is the sovereign power of a country to tax. That applies to all countries. Under a treaty, internationally, we agreed to limit my sovereign right to the extent that is agreed between the two parties. That is, two countries. They agree that, okay, even if I have a sovereign right to tax everything under the sky, which I need, but still I'll restrict to the extent that bilaterally we have agreed. Now, say, one treaty between India and Mauritius, we agreed that if a capital gain arises to a resident, then I'll be not taxing. So there is mutual sacrifices and gains inbuilt in the international agreement. So then that agreement does not extend to any other resident, because I can only forgo my taxing right if your resident, that is resident of another country, actually gains the incurs the capital gain or gets a capital gain out of sale of shares in Indian company. So therefore, when it extends, then the problem comes that this is not beyond the policy to forgo my sovereign right. So that is basically the court's argument, whatever. If you concise in a policy perspective, policy is that then it is who should then be, confirm that it is a tax resident. So that's what you say, that in Article 26 of Vienna Convention, it says that the country has to do a honest exposure that this is the tax resident. When that is actually breached, if you find out it is breached, then actually the agreement is nullified. So in policy, that becomes nullified when I breach this kind of agreement that I have already made. So basically, the whole exercise of Tiger Global in the Supreme Court judgment is to be seen in this light of how the policy has been agreed and how it has been to be operated. So that is how one must understand ki everywhere, every time, we should not apply the law or the nitty-gritty of law to understand what has happened. It is the policy one has to understand, that when a country exercises his restricts his right to tax, then it is agreed upon to the certain extent. And if that agreement is breached, then he has all right to apply his domestic law. That is how I want to tell.
No, I think very well articulated the entire judgment in 5 minutes. You briefed and the intent and why the government has done this. Thank you very much, sir. Now let me move to Mr. Chetan Rao, who and please just stay if you can stay, because I have one or two more questions to
I
you.
will stay for a while, maybe another 5 minutes. I have to go for RS Revenue Secretary's meeting.
Yeah,
So
yeah.
I'm there for five more minutes.
Yeah.
Listen to-
Because Mr. Chetan Rao also has a hard close, and we want to hear him as well, as
sure.
our audience has a lot of questions for him as well. So the Mr. Chetan Rao, thank you. Just to give a brief introduction, he's an IRS officer, a member finance in Delhi Development Authority, Government of India. He has high experience across assessment, investigation, international tax, and policy formulation. He has represented India at the OECD level and played important role in simplifying Sir, it's our pleasure to have you on board. Like Mr. Das has given our initial thoughts on the ninth consecutive budget presented by our Honorable Finance Minister. We wanted to hear from you, and then we have few questions, where we will like to have your views. Over to you, Mr. Rao. Thank you.
Yeah, thank you for this opportunity. And just to make a disclaimer that whatever views I expressed are my personal views and they do not represent the views of the government. So to begin with, like the JSTPL just gave the exposition that what is the clear direction of the budget, and that is something is very useful to everybody. And one has to see that this budget has clear sankalp. So when I say sankalp, the promises, which is focusing on poor, the underprivileged and the disadvantaged. And given the fact that this was the first budget that was prepared in the Kartavya Bhavan, just to give a context, that initially the finance ministry has always been in North Block, but last year only it shifted in the Kartavya Bhavan. So that is why you have those themes, the three Kartavyas, which Akhil, you had just spell out in your initial address, which is to accelerate and sustain economic growth, fulfill the aspirations of our people, and sabka saath, sabka vikas. So if you see the budget from that angle, you will see that everything fits in. You look for the tax, you look at urban development, you look at the various schemes that have been proposed. Even if you look very carefully at the spending, so somewhere it actually, you can put it in these three buckets. And from a tax perspective, if you look, the central theme is very clear. Simplification, ease of compliance, reduction in litigation, and greater certainty. So I won't go into that detail, but just that it is very important that there was a very hard focus on reducing tax litigation. And even if you look at the views that are all around, because even the newspapers and media, it's the direction is right, especially when at a time when there is so much uncertainty in the global landscape. So over to you.
Mr. Rao, I think very well said, and I like the way Mr. Das also said in his initial thoughts that this year our economy has not gone is over giving reductions on the tax rates, because the populist way of giving the direct benefit is reduce the tax rates, but indirectly by reducing the litigation, there's a lot of certainty and stability which businesses are getting, and that's where they're saving the more, rather than getting the direct tax benefits from the government, which is also in line of which you said. I have one or two questions for you, sir. I think the budget proposes dedicated real estate investment trust for central public sector enterprises to accelerate the recycling of significant real estate assets. How will this proposal strengthen India's infrastructure financing ecosystem? If you can share some thoughts on that, sir.
Yeah, sure. So just a small comparison, like what you mentioned earlier, that litigation will unlock a lot of tax, whatever is stuck, and also smoothen the experience. So similarly, if you look at the proposal of the REITs for CPSCs, that is the Central Public Sector Units, so it's a very practical reform. And when I say practical is because it actually strengthens the financial architecture which is needed for the infrastructure growth. As all of us know that the CPSCs are substantial owners of real estate assets. And by some estimate, it is more than 50,000 crores plus of a land bank. So what it does is it helps in capital recycling and also the balance sheet optimization. And now these assets can be, and many of these assets actually are mature and income generating. So by placing these assets in a trust, so we can unlock the value, and it's a very transparent manner and also a professionally managed way, and recycle that capital into the new infrastructure. So that is the real advantage of it. And plus another advantage that comes from this is that if you look at a public sector, it has a very valuable government office building, for example, which earns rent. So instead of leaving that value locked up, we can put it up in a REIT, and raise money against it and use it to build the infrastructure. And while the building continues to earn rent and investors receive payouts. So, in one way, if you look at it, it deepens India's infrastructure ecosystem. It reduces excessive dependency on bank credit and makes infrastructure financing more diversified and resilient. So it unlocks the cash without selling everything, funds new infrastructure using value that is already there, and also makes public assets professionally managed. Now, this move has also to be seen with another thing that is there is that this budget also proposes an infrastructure risk guarantee fund. So what it basically does is it uh, offsets partial credit guarantees during the development and construction phase. So in one way, REITs and this risk guarantee fund basically, if you look at one side of the equation, it actually leads to capital and confidence.
Thank you, sir. That's a fair summary, and the way the government smartly, planning to use this in the interest of larger projects and our economy and the public at large. It's commendable. Now, my second questions come to you. The government expanded the public expenditure of this year is to 12.2 lakh crore, vis-a-vis 11.2 lakh crores in the previous fiscal year. Further, it will continue to focus on developing infrastructure in cities with population of over 5 lakhs. I think the focus in the finance minister also focuses on the tier 2 and tier 3 cities. So how do you anticipate these announcements will impact the overall real estate and infrastructure sector as per you?
So again, this has to be seen in those three Kartavya themes. So this actually has a very strong message for continuity because in India, especially in a developing country, and especially in India, predictable public investment matters. And why it matters is because it supports execution capacity, reduces uncertainty for the private sector, and it actually crowds in private participation. So this private participation can come through various things like construction, financing, or long-term investment. Because as all of us know that the government no longer wants to be in the business. So that is why it's like a partnership. And the second part of it is that there's a continued focus on cities with population of 5 lakh. That is very important because that actually is related to balanced growth. Because these tier 2 and tier 3 cities are actually emerging as growth centers. And investing in urban infrastructure actually improves productivity and livability. So, and it also reduces that kind of migration that everybody only is coming to metros because if tier 2 and tier 3 cities grow, so which means that crowding in the metros also reduces. And this also integrates with the very fact of the urbanization agenda that we talk about, the city economic regions, where this budget focuses on amplifying the potential of cities. So this, when I say amplifying the potential of cities, again, if you look at those kartavyas, sabka saath, sabka vikas, so it gels into that, and it basically is that you harness the economic power of planned growth, agglomerations, and this actually sends a very positive signal that both infrastructure and real estate can be planned and it can be well connected to the urban regions so as to have a sustainable end user demand. And when you look at it, it also ties up with something that has also been referred in the budget, which is the growth connectors. Something that in the address that was being talked about, the increase to and the measures to strengthen the city to city linkages. So there are certain corridors that are planned like Mumbai, Pune, Hyderabad. So there are some corridors. And when you look at the overall picture, these connectors actually will lead to expanded labor markets, new commuters, support the growth housing. So everything, all of this is pretty connected. And something what you had also talked about was initially was the municipal finance, the bonds that is being proposed as an incentive for 100 crores of that. If you have big bonds like 1000 crores, then you will have the kind of an incentive of 100 crores, because we already have something of a smaller, for smaller instances, say like 200 crores. We have that Amrut scheme, which is the Atal mission for rejuvenation of urban transformation. So now the focus is not only on small regions, but also in big cities where municipal corporations, because when we strengthen our urban infrastructure, plus with focus on tier 2 and tier 3 cities, so it actually has a very positive medium term impact, because ultimately it encourages infrastructure it and a balanced urban expansion. So that is all the focus is about. So over to you.
Yeah, no, thanks, Mr. Rao. I think very well articulated, and the way you explained, obviously we've seen how private participation has helped the infrastructure in the country, and with the focus of cities with with population of over 5 lakhs, the government gets a better way of developing so that the people from metros or tier 2 cities started going and utilizing that infrastructure for the overall growth. And as you rightly said, sabka saath sabka vikas. We thank you and Mr. Das for your availability and your insightful thoughts on with the intent. The budget is being drafted and giving very rational I think illustrations and explanations to the public questions at large. Thank you. Now let me move
Thank
to
you.
our tax experts who've been waiting for their to share their thoughts. At last but not the least, as you know, we are today joined by tax experts to help us record the tax proposals. Richa Sani is a partner with tax planning and optimization at Grant Thornton Bharat. She comes with an experience of 30 years in direct and international tax. She leads a direct tax technical firm. As well, Richa is a fellow member of the ICA and a cost accountant. She has vast experience in handling diverse and complex issues in direct tax, international tax, transaction advisory matters for a varied set of clients across several sectors. So we welcome to you, Richa, and thanks for patiently hearing and waiting for your turn. Let me introduce the other, technical experts so that I'll hear your, perspective. And you've heard the government, you've heard the president of IACC, and even the India-US economy. So we'll get back to you very shortly. So the second tax expert we have from the indirect taxes is Manoj Mishra, who's again a partner and tax controversy management leader at Grant Thornton Bharat. He leads tax controversy management and specializes in indirect tax and regulatory advisories. He supports organizations across industries on GST, compliance, litigation, process optimization. His work emphasizes practically business aligned solutions tailored to the complex tax environments. Thank you, Manoj, for joining us today. My last expert is Mr. Sandeep Sehgal, who's a tax partner at AKM Global. Mr. Sehgal is a chartered accountant and registered valuer with over 13 years of experience in international taxation, exchange control matters, ESOP structuring, high net worth advisory. He has led valuations for listed and multinational organizations and contributes regularly to leading financial publications. He has provided strategic guidance to high net worth individuals on income tax planning, wealth transfer, estate planning, retirement, business succession planning, with so much of experience. So I'm glad that you accepted the invite and be with us. Now I'll go back to Richa to share her, initial thoughts, her first impression on this year's budget. Then Manoj and then Sandeep. Then I have a lot of questions for you so that we can, before we conclude today's session, we'll have holistic perspective. We've heard the government dignitaries. We have heard Mr. Chawla. We wanted to hear from you, and then we can conclude the session. Over to you, Richa.
Thank you, Akhil. I think overall, from a direct tax perspective, the crux is simplification. We heard the FM reiterate that this year the new Income Tax Act is coming into being. There has been some apprehension from taxpayers' side because the rules hadn't really been released so far. So that she's clarified. So that's a clear direction towards simplification. The other is, of course, ease of compliance and the thrust that we have seen this time to make dispute resolution less cumbersome and less daunting for taxpayers. I think so. These are the three key areas that stand out from a direct tax perspective.
Thanks, Richa. Thanks. And I think this is very much in aligned with what Mr. Das and Mr. Rao just mentioned in their discussion with us. Now I'll go to Manoj for his first impression on the budget.
Hi, Akhil. So I agree with our previous guest that this budget is for the development. This budget is for stability, implementation, and consolidation. So, like, it will have a far-fetching impact, and the restraint from doing like any populist announcement, and they focused on consolidation. So yes, like for me, the budget is some sort of a budget for yellow economy where development has been in the center.
Thanks, Manoj. I think as Mr. Das also put a lot of emphasis on this specifically, that we wanted to give a lot of certainty and we wanted to do the consolidation where the businesses knows where in which jurisdiction they are dealing with it, and they can have a competitive pricing while dealing on their businesses. Now I'll go to our next panelist is Sandeep, tax expert, to give his first impression before we come to the specific questions and answers.
Yeah, thank you, Akhil, so much for the nice introduction. So I think I broadly agree with other speakers. I think what I could make out from this budget was that it was very much concentrated, and especially related to tax aspects, that it was very much concentrated with respect to, I would say, reducing the litigations, tax certainties, and as we can see, there are a lot of provisions related to decriminalization of certain offenses. And there have been efforts to reduce a lot of hardships in procedures for different class of taxpayers. So I think the direction is very good, and I am hopeful that this will this budget will serve as a good tool for the tax implementation and the overall economic perspective.
That's good to hear from you, Sandeep. Now I'll go to Richa. My first question to you, Richa. I think there seems to be a lot of announcements on simplification, as you also said, decriminalization of minor offenses and dispute resolutions. How do these measures contribute towards the government objective of overall rationalization and ease of doing business? I think Mr. Das emphasizes a lot on this, but as per you, how this will contribute towards the government overall objective?
Yeah, so Akhil, taxpayers have always felt that litigation in India is a very time-consuming and a costly affair. So we see a lot of changes that are proposed this time to address this concern. While Mr. Pitambar Das did touch upon a few of them, I'd like to talk about ones which stand out for me. So one, I think, is the avenue of early closure, which was earlier available to cases which were termed as underreporting. That avenue is now open for misreporting cases as well. So what it means that you can expect a lot of those sort of taxpayers where the tax demands were smaller amounts, where the business were on the verge of closures, or where in effect the taxpayers just wanted to focus more on the business side and less concentrate on the dispute resolution aspect. They can seek an early closure of the dispute under this new avenue which gets opened up for them. So what it will do is, we've observed that at the CIT level, that actually becomes a choke point. There were about 5.39 lakh cases is what the last data for 31st March 2025 kind of shows. So this will help unclog the system. Also, we've seen that the government comes up with periodic amnesty scheme to give avenues to taxpayer to close their open litigation. So this will provide a regular avenue and maybe just does away with the need of those regular amnesty schemes, because then this unclogging can take on a regular basis. The cleanup in the system can keep happening. So this was one. The other is the fact that the assessment and the penalty orders, they will be combined. it becomes much easier for taxpayer to handle, the litigation right at the inception stage. So less cost, less time and effort involved. That's a great point. Again, when you went in for an appeal at the CIT appeal level, 20% pre-deposit was required, which created cash flow issues in many, many cases. So when that is reduced to 10%, a lot of the issues on the cash flow sides get addressed. Interest on penalty, again, that is to be kept in abeyance. That's a big point, and that's irrespective of the outcome. So a great help again for taxpayers. Now coming on to the decriminalizing side of things. In October 2025, Niti Aayog had made a lot of recommendation on the decriminalization of offenses. And the crux was that the punishment has to be proportionate to the default that is committed. Keeping those in mind and accepting many of those suggestions, the changes that have brought about have actually made many significant changes in this area. A lot of rationalization has happened. For instance, the nature of imprisonment that has been converted from the rigorous to the simple imprisonment. The maximum punishment, which was around 7 years, that has been sizably reduced. It's become maximum is now 2 years and 3 years in the case of a recurring default. And also it has been tied up with the quantum of the tax default. So if the tax default is up to 10 lakh, there is no imprisonment involved. Then if it is 10 lakh to 50 lakh, then it is 6 months. And beyond 50 lakhs, it's 2 years. So that's a big relief. In many cases, it's only then fine. So if it's less than 10 lakh, you only end up with fine. There is no imprisonment involved. There is full decriminalization of many cases. For instance, if just a failure to produce the books, or if you've not really paid the TDS amount collected in the cases where it was wholly or partly in kind sort of cases were involved. So all these cases, there has been a full decriminalization. So I think all these steps put together, they provide a lot of relief to the taxpayers, and they make the litigation system quite less cumbersome and daunting for the taxpayers.
Thanks, Richa. I think that's very useful, the way you put the numbers on the kind of reliefs which government has come out with. Now I'll go to Sandeep, taking this forward. Well, Sandeep, as we understand that budget offers one-time amnesty for undisclosed as foreign assets held by individuals. Can you please elaborate on the conditions required to be met to take this benefit of the scheme? And you just talked about overall relief and simplification and on the litigation, but specifically on this, if you can throw some light.
Yeah, sure. So I think some of the contours of the scheme would be notified later in the rules, but what we have in the fine print is that I mean, if you have missed disclosure of foreign assets or foreign income, sorry. So you may not file the return, or you may have filed it, but you not made the requisite disclosures, or maybe those incomes of assets may have escaped assessment. Then those taxpayers are basically eligible to get the benefit of this particular scheme. So the legislature will provide a 6 months window where a date will be notified, and within this 6 months window, you will need to apply online for this, and the department will examine your application within respond with a certain time, and then you need to pay your taxes. However, there are two, since this scheme is for small taxpayers, so they have put a limit of 1 CR where the undisclosed assets and undisclosed incomes had not been reported for resident taxpayers. And for other class of taxpayers who were, let's say, non-residents earlier when they acquired those resident assets and they have become residents now, or they may have disclosed the incomes out of which they bought those assets, but they failed to disclose those assets. So for them, the limit is 5 CR. So if your foreign assets more exceeds 5 CR in this case, then you are only required to pay a fine of 1 lakh rupees. However, for the category of residents who have undisclosed assets and undisclosed incomes, they would be required to pay a tax of 30% on the amount of undisclosed assets or incomes. And plus there will be 30% further amount you can maybe call them penalty or fine as such.
So I think hearing you looks like that government wants to give that opportunity, because there are a lot of people who in the last decade acquire some assets, but
Yes.
not able to disclose. I remember that Black Money Act came in 2014, and before that I'm not able to recall the exact year, but I think this brings a lot of relief for those kind of people. I personally know in my relation also that they were not aware about this, and this immunity will give an opportunity for them to disclose their assets. So
Yes.
very very
And yeah,
very good
and so
development.
and just to add to this, I mean, there has been amendment in the Black Money Act as well, where they have done away with the prosecution when the undisclosed amount of assets and income does not exceed 20 lakh rupees. So I mean, we can see the team running that for any kind of smaller offenses, they are doing away with decriminalization in such cases. I think this is the
Yeah.
right step.
Yeah. Now I'll go back to Richa. Richa, can you please throw some light on the budget announcements done with respect to the applicability of MAT provisions? Also, what are the exemptions provided from MAT provisions to non-resident? These two questions people want to understand in detail.
Yeah, so I think the changes that have happened in the MAT regime, they are a continuation of the kind of nudge that the government provided in the individual tax regime by making changes in the new regime to make people move to the new regime. So something akin to that has happened here. So what we saw when the new tax regime for companies had come in, a lot of companies abstained from moving there because there was a lot of accumulated MAT credit available. And the decision was, let's exhaust this first. And once that is done, then we kind of evaluate whether we need to move to the new regime or not. Some of the data numbers that recently some of the government officers shared was that only 58% of the companies have moved to the new tax regime. Now, from the government's perspective, the way forward is the new tax regime because it's simpler to comply. There are lesser exemptions and deductions, so easier to implement and administer also. So the thrust is to make more and more companies also move to this regime. So what they have done through these MAT tweaks is to give that bit of nudge to move to the new regime. So what is proposed is that going forward, the carry forward and set off of MAT credit is only available in the new regime. So what can be done is that the credit balance that is available, the MAT credit that is available on the 31st of March 2026, that would be only available if you opt for the new regime. There is then a cap that every year you can only claim 25% of your the tax under the normal category that is available. To that extent, the MAT credit can be available. The remaining can be carried forward to 15 years. But of course, the 15 years you need to count from the day in which this actually originated. Not that, this gives a 15 years new lease to the MAT credit once you move. As far as the old regime is concerned, MAT is now the final tax liability. So there is no more accrual of MAT credit that will happen there. The rate has been reduced to 14%. So for all those who were just waiting that, let us exhaust this MAT credit and then move, this is the right time, because now going forward, the credit for the accumulated MAT credit is only going to be available if you move to the new tax regime. So this is for the domestic companies. Now coming on to the foreign companies. So the key aspect here is that the exemption from MAT has now been given to all companies which are availing the presumptive tax regime, which in effect means that the presumptive tax regimes that were recently rolled out, like the taxation of business of operating cruise ships, or providing services or technology in India for setting up electronic manufacturing facilities, the MAT exemption is now available for these two areas as well. For the others, the rate is reduced now from 15 to 14%. This again is the final liability. That means just like in the case of the domestic companies, there is no accumulation of MAT credit that will happen. But as far as that cap of 25% is concerned, that's not there in foreign companies. So they will continue to avail the credit as they were doing in the past. So in a sense, that is what it is there about all the changes that have proposed on the MAT front.
Thank you, Richa, and I like the way put the numbers behind each and every description you're giving. It gives a lot of relatability. Now I'll go to Manoj. Sandeep, please hold on. I have one more question, but I'll come back to you as people must be waiting to understand more on the indirect tax front as well. So Manoj, does budget 2026 enhance export competitiveness in the US by easing intermediary provisions and GST refund bottlenecks, especially for MSMEs and global GCC, and in light of whatever happened last night?
Before we get into, let's understand the importance. India export to US, service export to US would be somewhere around 90 billion US dollars. Okay. And out of that 90 billion, 60% would be towards IT, ITS, and GCC. Okay. So earlier, whenever they used to export, and you know that export is zero rated, eligible for all kind of incentives, department would try to there was a dispute going on, and they will say that these are intermediary services, and intermediary services export would not be treated as zero rated, as they are supplying from India, and the place of supply would be the place of supplier, that is India. Okay, so that was not being treated as zero rated. So there was a dispute going on for decades, I would say. Even in the previous regime, it was a big issue. And this was despite various court judgments and departmental clarification. So now they have removed that place of supply clause from the definition of intermediary. So even if they try to classify any service as intermediary, it would qualify as export, and exporter would be eligible for all export incentives. So that is a big relief to the exporters. As I mentioned, that these are who are 60% of the total service exporters to US. So that is one major relief, which was in principle agreed in 56 GST Council, and now it has been implemented. The only question remains that since these are prospective amendment, what would happen to the legacy issues, whether they would be treated in the same manner or there would be some clarification issued by the government in this regard. So that is one. Second is that they have removed the threshold of rupees 1,000 for refund. So though it may look like very small thing, but if you think from the perspective of small exporters who are exporting through couriers, so their one consignment would be very small, and their refund cannot be more than 1,000. But like if you a sum total would be a huge sum of money, at least for MSME. So that cap has been removed. So any export through courier or any small amount would be eligible for refund. So that would be a big boost to MSME exporters. Apart from that, I would also say that they have come out with the tariff reduction. Though we are it is at initial stage, we have to look at the fine print. There are some contradictions because they say that it has to be 500 billion US dollars business, whereas we are, as of now, we are less than 50 billion US dollars. And they are also talking about India agreed to stop buying Russian oils, whereas Russia says that we have no communication in this regard. So we'll have to be very cautious before taking any policy-related decision on US tariff. So I would say, all in all, a very good initiative by the government, at least for service exporters and MSMEs.
I think I can understand, Manoj, but the market has accepted it and give a big thumbs up, positive. You've seen the where the market has gone, which on Sunday it was other way, and I had that question for Mrs. Chawla, but unfortunately we were not able to ask because of my system error. But one more thing, Manoj, I want to check. I think we are bang on time, but we have two questions to close. Can a simpler tariff structure combined with digital custom reforms translate into reduced litigation and faster dispute resolution in practice?
Certainly, Akhil. As promised, And as I mentioned, they are talking about consolidation and simplification rather than new announcement. So one that the cumbersome tariff structure where we go to, like if you have to find customs rate for any particular goods, first you will go to customs tariff, then you will go to general exemption, and then you will find that rate, then you will go to conditions, etc. So it would have taken even for a seasoned professional a couple of hours to be sure about any tariff rate on any particular item. So what they have done, and they are trying to do it in a phased manner, that either they are removing exemption and bringing in that line item in the tariff itself, so that you can find everything at one place without any confusion. Okay, so that of course is ease of doing business. Apart from that, they are also trying to consolidate like website of customs into one website like GSTN, where the importer will be able to use it for all the purposes. So that is another ease of doing business which they are doing. And definitely in terms of tariff rationalization, where focus is to provide concessional rate of taxes on imports and let finished product be on normal rate, that is again going to give boost to make in India. So definitely, I would say that even on technology and even on rationalization, it is a very good move by the government.
Thanks, Manoj. My last question before we wind up today's session to Sandeep. Sandeep, what is the thought process behind rollback of dividend tax on share buyback and the introduction of capital gains, especially for promoters?
So I think in our view, they are trying to keep it simple. I mean, if you see the earlier regime, I mean, you are taxing this in the in the hands of the company at one end, and on the other hand, you are allowing a loss to the shareholders. So in a way, you're making the process cumbersome. And I think what they are trying to do is and this actually make the thing simpler for everyone. And in the same way, I mean, it gives greater flexibility to the shareholders as well, specifically, so to say, the retail class as such. Uh, because I would say, I mean, the buyback or dividend, so to say, are not as tax-friendly options as a capital gain. So I think you would want more decision making in the hands of the shareholders as such who are affected by this. And as we have seen in the past as well, in the last few buybacks, I mean, the retail shareholders uh, may not have shown as much enthusiasm, and because primarily these are driven by the promoters for their own tax planning purposes. So I think the idea seems to be that if you're doing a buyback, this should be for the purely commercial or capital structuring purposes rather than for the tax planning purposes of the promoters, where the retail shareholders, so let's say even in the private company where there are no retail participation, uh, they are not having a skin in the game as such. So I think this is what seems to be my personal view in this case.
No, thanks, Sandeep. Thanks, Manoj. Thanks, Icha. I thoroughly enjoyed the entire conversation. I would have loved to extend this by half an hour, but I know we've kept it for 1.5 hours. Very, very great insights from our president, Manoj sir, and then Asim sir. And then we have our guest of honors who's given a lot of intent, and the theme was three kartavyas, simplification, consolidation, and clarity to the businesses at large. So this year budget looking into moving into that direction of fulfilling all the three duties which our honorable finance minister laid down with so much of focus on infrastructure, tier 2, tier 3 cities, simplification, less litigative. And once again, thanks Indian-American Chamber of Commerce for giving us this opportunity to have such an insightful discussion, and have esteemed panel and our participants who've been with us throughout this session. If anyone wants to give concluding remarks, Lloyd, because I know the Lloyd, we started with him in the beginning, but now he's been with us for the last 1.5 hours. So anything, Manoj, Richa, Sandeep, and Lloyd, you want to say before we conclude today's session?
I think very well summarized by all the speakers, but I think just concluding comments for me is that from my perspective, the budget is uh, refreshingly so a very forward-looking budget. In several years, we haven't seen something that is not so populist, but really towards driving a trust-based, tax policy practice, creating incentives and making India attractive for, corporations to come and set up businesses here, attracting foreign capital, making our manufacturing industries also more competitive, and keeping the landscape clean for companies which are complying the safe harbors, introducing tax certainty. So all in all, I think from my perspective, something that is very forward-looking and propelling our economy in all fronts going forward. Yeah.
Thanks, Lloyd. Very well said. Anyone else who wants to give their concluding remarks before we leave the platform?
I think for me, this budget addresses quite a bit of pain points that taxpayers have been talking about. So the thrust on simplicity and tax certainty and making disputes less painful, I think they really stand out in this budget.
Thanks, Chetan.
Yeah, and so I think as I have stressed earlier, I think what they have tried to done is that they have tried to keep the things simple for different class of taxpayer. For example, little things like filing your Form 14G and H to a depository. So you don't need to furnish it to every single company for the year which you should hold the shares. And similarly, applying for the LDC online only and making the whole process transparent and online only. I think these small things actually go a long way. I mean, generally we talk about big measures, but the thing is that these kind of measures actually make the life easy for the taxpayers on a day-to-day basis. So I think they have addressed these kind of things, and which is, I think, in my view, very commendable.
Thanks, Sandeep. Manoj, anything from you?
In my opinion, it is progressive and forward-looking and for stability.
Thanks, everyone, once again for your time and giving those insights. Let's meet next year in 2027 with the bigger aspirations and forward-looking budget. Thank you. Thanks, everyone.
Okay, thank you. Thank you. Bye.